Hello and welcome to this week's US Stock Market Report. I'm Dale Gillham, Chief Analyst at Wealth Within. This week I'll be discussing 5 ways that you can get rich, and then I'll dive into the Dow Jones Index, the S&P 500 and Tesla, which is in the news right now. Now there are 5 ways that you can build your wealth and become rich. These range from being tight or very frugal with your money to borrowing to invest in business or investments. I will go through all 5 in no real order of importance. Now you may choose to do one or more of these at any time during your life. Number 1, getting into your own business. Now this is often considered the fastest way to get rich, and that's to start and build your own business. But it's also one with the highest amount of risk. Today, young people get bombarded with books and videos on becoming the next millionaire from running an online business or building the next big app. Becoming successful at business is not as easy as they all make out. Running a business means you'll have to be willing to take risks, work hard, and at times be a bit lucky. 90% of businesses fail in the first few years, as often those with an entrepreneurial spurt of genius realise that it's not as simple as it seems. That said, being in business for yourself can be quite rewarding, not only financially, but in many other ways. Now, number 2, borrowing to invest. When building an investment portfolio, timing is a critical factor. You see, the rich do not follow the herd. Becoming rich through investment is acting opposite to what the majority do. The herd attempts to follow the rich, but get it wrong all of the time. The research that I have done is that those who are not rich tend to move their money into the market before the peak and out of it after the crash. They also borrow the most just before the peak as they try to get rich quick, only to find that they lose as the market falls away. The fastest way to make big money is to borrow it and put it in good investments. It just makes sense, as there is more to compound and the interest is tax deductible. Now the problem with borrowing to invest is that the majority want to make $1 million, but only have a few thousand to start with, and so they leverage or borrow way outside what they should, and so it's taking extreme risk and they end up losing. Smart use of borrowing for investment is generally the quickest and surest way to gain wealth for those who are educated in how, but it can be a big downfall for those who don't. Number 3, property. Property is always part of a plan to create wealth, and most successful people will have one or more in their portfolio. Whilst you can't get rich quick with property, it's great for long-term wealth creation. Now the rules for buying residential property really don't change, and they are close to the city or a major hub, close to public transport and close to schools. Number 4, the share market. One of my catch cries is that becoming rich through the share market is not about how much money you make on any one investment, it's how much you do not lose. If you lose 50%, then you need to make 100% to get back to where you started. If you lose 10%, then you only need to make back 11% to break even. The challenge is that so many attempt to get rich trading high risk or highly leveraged, only to find out that they get the opposite of what they were attempting. Where those who are successful long term are patient and open to opportunities as they present themselves. Interestingly, those who have the knowledge and experience to trade in high risk markets generally don't, and those who don't have the knowledge and experience generally do. The stock market is a great wealth creation vehicle, as it can give you cash flow to place into other wealth creation vehicles such as property and your own business. Now number 5 is budgeting and tax. Let's face it, the rich don't generally pay much tax, and so proper tax planning can be crucial to your wealth creation, and getting good advice on this area is better done earlier than later. This brings us to budgeting, and in my experience, those who are not rich don't do it, and those who are do. Rich people don't overpay, but they do understand value. Those who are broke know the price and have very little idea of value. Wealthy people know that every dollar saved and invested today will be worth more later on. Remember, Buffett once said, someone is sitting under a tree today because someone else planted it a long time ago. Set a budget and follow the laws of wealth creation. And this means pay yourself first by setting aside 10% of your wage to put towards your wealth creation. Now let's get into the charts. Okay, on your screen at the moment, we've got a weekly chart of the Dow Jones Industrial Index here. And you can see here how the recent high was in January at 26,616 points. And the last week, we've seen here this market close at 24,103 points. Did look a little bit bullish, but the interesting thing to me on looking at this last week, if I expand this last bar out, so you can see it a little bit better. You can see how it opened in that bottom 1/3 of the bar. It did try and push right up at the close at the end of the week, came right back. What it didn't do is come back into the bottom half of that bar. If it had done that, I would have suggested the Dow was more bearish and highly likely to trade down lower in the coming week, maybe even next few weeks. Interesting thing on the Dow at the moment, it hasn't broken below that February low of 23,360 points. Now, if it had broken that in that week, that 23rd week of the 23rd of March, or the week ending the 23rd of March, then I would suggest it was definitely falling down to 22,351. But I think that's the level we're looking at anyway. This week will tell, if we start looking at the Dow, this week will tell if it starts to fall away and breaks below the prior week's low, which is 23,509 points. It was highly likely then to break the low of the 9th of February bar, that week ending the 9th of February, and it should hit into that. What I want to show with you is why I'm thinking that. If I bring this back, you can see, if I go back here, you can see the next move, and I'll just contract that a little bit. You can see how the move from way back here in, what's that one? Let me get my pointer on the right bar. 2011 to this high through to here in 2015. It fell down to that 38.2% mark. And if I go back a little bit further, you can see from the March 2009 low through to the high in May 2011, again, it fell down to that 38.2%. So it's quite common for markets and stocks to fall down to that. They can fall further. They can fall down to the 50% level and even further. At this stage, I think the 38.2% level is probably going to pick up the Dow or pull up the Dow over the coming weeks, possibly maybe a coming month or so, but I don't think it'll be too much longer than that. We are searching for a low at this point in time. Let's go and have a quick look at the SPY only for a few seconds before I get into Tesla, because it has been in the news a lot lately. Here's the movement on the S&P 500 from the 2009 low in March 2009. Again, here looking at 2,030 points. Is that I don't necessarily think that's going to go down to that, because you can see how the S&P 500 looks a lot more bullish than the Dow does. You can see here it's only got one. Its high here was in January 2018. Again, like the Dow, we've had a down month down, and this bar is not looking quite as bearish, but it's not looking as bullish as it should, but it's a little bit better than the Dow, I think, in terms of more bullishness, because there's more stocks in it, obviously. Looking at the Tesla, let's get into that. I've got a monthly chart of Tesla, and you can see here, this is the whole monthly or the whole data that we've got on Tesla. Interestingly, in Tesla, if I just draw a couple of trend lines across here, you'll see this sort of consolidation or distribution type of pattern here. It's pretty common on markets. They move from equilibrium to disequilibrium. And what you'll see here, we've got another one down a little bit lower here. So if you go down from when it first started, you see this period of sideways-ish type of movement. And if we put these sorts of lines on it, you'll see it goes between these sorts of lines, and then it breaks out. So while it's going sideways, it's more or less in equilibrium, where buyers and sellers are generally agreeing, and they're agreeing within a price within a price target range, sort of like $1 or $2 or 1 or 2 or 3%, and they're doing that, and then they'll break out of that as one side takes over. We've had a bit more of a consolidation through here, so I put my lines on here. We've done it again with Tesla, and at the moment it's just broken out on the downside. I'm suggesting it's probably got a little bit further to go. Not right now is not the time to buy Tesla. A lot of people will be getting into it going, wow, it's fallen down. And if we actually put on our cool little tool, you can see here from the high, it's fallen 36+% since that high back in, what date was that? That was September 2017. It's still got a little bit further to fall. I think Tesla will probably fall down to somewhere into around to that 230 sort of $6-ish range. It may fall a little bit further than that, but I'm guessing it'll fall probably into that middle of this range here. So if I put my little tool on here and I put it from that top part to this bottom part, and I put a horizontal line. Where's a horizontal line here somewhere? Okay, I don't have one. I'll just put a trend line in through that middle bit there. You can see here roughly around about that sort of 220 to 230 mark will be roughly, I think, will bring up Tesla. Let it hit that. Let it see if it finds support. Let it start to trade up on that. If it does do that, then that will be a nice little buy coming in a few months. Tesla is a good company. It's very innovative and a lot of people like it. So it's fashionable to own Tesla shares. Right now, it's too dangerous to buy into them. If you do own Tesla shares, I would suggest you probably should have exited a while back rather than still be hanging on. Just using a trendline rule, you would have exited this stock somewhere back, through into roughly around that $320 area around July last year, and you would have been sitting in this downward range. It does tell you, good stocks tell you when they're starting to fall. So learn a few skills and you'll be able to get in and out of the market easily. And all you need is a rule and a pencil. I teach you about that in my book called Accelerate Your Wealth, which is out in the US mid-year, about July. We're looking at launching that there, but Accelerate Your Wealth will teach you how to do this quite simply and easily, just with a rule and a pencil. So that's it for the charts for this week. What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on SoundCloud and on our website. Now they're jam-packed with valuable information which will help you elevate your trading. Now if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck and good trading.